thank you. So this is joint work with Michael Weber, and this is about beliefs in portfolios, causal evidence. So let me first convince you why this is really important. So, so here you see basically the asset pricing equation that is in every economic model, and as you can see, in a sense, asset prices are expectations because whenever the price moves, it has to be that some expectation is also moving. And so therefore, as Stefan Nagel puts it, we might guess that everyone in asset pricing or in finance is working on expectations, but that's not the case. So, and one reason why that's not the case is, well, one reason is, of course, that there are also like other interesting things to study, but one reason is also that economists have invented rational expectations, and of course, if you have a rational expectations model, the beliefs are model implied, and so there's no separate role for beliefs. However, there's trouble in paradise, so basically, so rational expectations predict that the expected returns should be high when the valuations are low. But as many of you probably know, empirical evidence of individual beliefs shows exactly the opposite. So what you find is that expected returns are high when valuations are actually high. So you have households tend to expect high returns during a boom. And so therefore we kind of are in this research program where we try to understand how individuals actually form their beliefs. And obviously this has implications for asset prices and macro dynamics. But what is also interesting is that there's this connection to financial intermediaries, because like perhaps you know this recent research by Koyen et al., who show that basically flows from households to financial intermediaries can have really large consequences for asset prices, for instance, due to tight investment mandates of these intermediaries. And then, of course, like asset prices with subjective beliefs, this matters also for monetary policy and financial stability. So if you think of asset price bubbles, so that's also something that is typically not possible when you have rational expectations, but it's possible when you have subjective beliefs, and of course that's something that policymakers are very concerned about. And then finally, household finance. So basically, if you have heterogeneity in beliefs, this matters for the distribution of wealth, right? So what exactly do we do in this paper? We try to find out which mechanism shapes stock market expectations causally. So we try to identify causal effects via a randomized controlled trial, which we embed in a representative survey of 4,000 German households. And this allows us to test leading asset pricing theories jointly. Here are our main findings. So we find causal evidence for the extrapolation of returns and earnings, so relating to basically a literature on return extrapolation, and a more recent literature emphasizing more the extrapolation of earnings. We find a new information preference effect, which kind of suggests that people have heterogeneous mental models which influence not only how they process a given piece of information, but also which information they select to acquire. And then finally, we show that beliefs causally affect portfolios, and that conditional on the beliefs that the people have, they behave quite rationally, which is also important information for modeling. So let's quickly recap the RCT approach. I'm sure many of you are aware of it, but perhaps not everyone. So this approach is widely used by now, and it basically works like this, that you elicit prior expectations for all respondents, then you randomize your population into groups, and you have a control group and several treatment groups. And so each treatment group receives a different information item. Control receives no information. And then after the treatments, you re-elicit their expectations. And so this gives you basically the causal effect of these information treatments, which is intuitively, it's basically a difference in difference. So it's basically the expectation revision in the treated group minus the expectation revision in the control group. So here are information treatments. The first one informs people that the current price earnings ratio of the DAX is 23. And we also elicit what people's initial perception of the information they were given was before the treatment. And so this prior perception was 10, so it's quite a large difference. And so if these people had rational expectations, you would basically predict that they would revise their expected returns downwards. Right? The second treatment is basically meant to test extrapolative returns. So we tell people that the DAX has increased by around 9% over the past 12 months. The prior of this information was 5%, so if they extrapolate, we would expect an upward revision. Then we also want to test these theories of extrapolative earnings growth. So we inform people that past earnings growth was 20%, their prior was, past earnings growth was minus 20%. So this was actually, we conducted this experiment in September 2020. And so during the Corona pandemic, and so there was a negative earnings growth, and interestingly, people had not, apparently had not really realized that, right? And so now we inform them about it, and so if they extrapolate, we would expect them to revise their beliefs downwards. Yeah, okay. So basically, so people go into the survey and they think, you know, like earnings growth is like 4%, and like maybe on average, like it was many years or so. But then you tell them, no, it was minus 20%. Yeah, so it was a decrease. And so then basically if you, so yeah. Okay, then, so the fourth treatment is meant to test these theories of, you know, where people are influenced by experts' forecasts. So we give them an expert forecast. And finally, we also, the fifth treatment gives people information about the long-term average equity premium. And we will see how they respond to this information.
Those are accurate statements, right?
Those are all truthful statements, of course, yeah.
So the priors were egregiously wrong.
Sorry?
So the priors that they stated in the survey were very wrong.
Yes. Mostly, yeah. So actually they were doing pretty good for the long-term average. But it's in the paper. I didn't put it here because we are focusing on these first three, but yeah. Yeah. Sorry? In the real world, they may not be exposed to this stuff. Yeah. Yeah.
So the effects in the real world are probably going to be very different to what they're arguing.
Yeah, so I guess, so your point is that it's, in some sense, it's artificial because we are just imposing this information on them. Maybe in the real world, they might not have even looked at this information. And so, okay, and so the point is that, of course, we want to have this controlled setup because this allows us to identify the effects very cleanly. Like in the second part of our experiment, or basically we run a follow-up experiment where we did an information acquisition experiment, where basically we asked people which information they would choose and how costly they perceive this information. So that's kind of getting a bit at this point that in reality, of course, people don't get assigned information, they choose this information, and you will see we have some very interesting results on that as well. Thanks. Perhaps one quick question and then I'll move on. Yeah. Well, so, I mean, these are obviously different pieces of information. So one is the price-earnings ratio, and one is the past return, one is the past earnings growth. And so the point is, so these really relate to these theories, right? So if you have a model with extrapolative returns, then you're assuming that people are have beliefs about you know, the return process, and then they update their beliefs whenever there's a surprise realization, and so you get this extrapolative pattern. That's what we want to test here, and the same basically applies to the earnings one. And then regarding the price earnings information, so this is kind of a little bit based on the Campbell-Schiller equation logic and also on the return predictability literature. So basically, I mean, you know, if you believe that the prior price earnings ratio was a 10, and now you're informed it's a 23, so that means that basically your earnings yield goes from 10% to around 4%, so that's quite drastic. And so if you don't adjust your returns in that case, it means that you probably don't have rational expectation, and it probably also means that you don't understand, you know, like the stock market, and you don't understand like price earnings ratios very well. So that's kind of the idea. But maybe let's move on and then show you some results. So that's our econometric approach. So let's see. I guess we are still doing well on time, but I will wait a second. But now I have the 30 minutes, right? Because we have questions in between. Okay, so this is the econometric approach. It's quite standard. So basically, to give you a simplified example, so here the revision in the control group is just alpha, and the revision in the treatment group is just alpha plus beta k. So the difference in difference is beta k, and so therefore beta k measures the causal treatment effect, and these other terms are there to control for certain effects. But let me show you here the main coefficients. What we basically find is that there's no significant response to price-earnings ratio information. And this holds both for 1-year expected returns and for 5-year expected returns. But we do find that people extrapolate returns and earnings growth. So you have here the positive coefficient of around 2% for returns and a negative coefficient of around 3 percentage points for earnings. So if you think of asset pricing, so these are actually quite large effects, right? And then for the expert forecasts, we also find that people update in the direction of these expert forecasts. For the long-term average return, the treatment effect is insignificant, but I will show you why this happens on the next slide. So here we look at learning rate. So this basically gives you the expectation revision per unit of the news received in the treatment. So here on the horizontal axis, you have the perception gaps, and on the vertical axis, you have the expectation revision. And so what you see is that the orange line really stands out because it's very flat. So this means that you have an exceptionally low learning rate for price earnings information. Whereas for the other treatments, you have sort of similar and positive learning rates. And that relates also to, and that includes the last treatment about the average long-term return. So basically what happens is that to the extent that people are not very well informed about the average long-term return, they update with a similar strength than, let's say, for the past 12 months return. But it is the case that they are actually very well informed about this long-term average equity return. And that's why we get the insignificant average treatment effect, but we get a pretty high learning rate. And we also interpret this as being basically consistent with Malmedy and Nagel, who say that people overweight recent experience, because if you react to this past 12 months return in the same way as about information about the last 50 years, that basically means that you're overweighting this recent return. So now we turn to information acquisition, which was already asked here. So like we said, in real life, individuals choose information. So first we elicit people's ranking of information prior to the treatment. And here basically interestingly, what comes out is that this looks almost like a uniform distribution, right? So there's really a large heterogeneity of what people think is important, and basically for every information source, there are some people who think that this is like what they would like to see to form their expectations. And so this is actually good for our experiment because we can exploit this large dispersion in these information preferences. And so what we are asking is whether, or let's say, so this gives us two things. So first of all, this gives us already this information, what people might select in practice, and we also have, later we ask them also about the cost of acquiring this and so on. But then the other question is, like, suppose people would acquire this information in real time, would they then respond differently to it than in our experiment? And this is kind of what we are trying to get at this. And the answer is not obvious, because someone who chooses, let's say, the price-earnings ratio as his information might react less to this because he might have a smaller perception gap. But on the other hand, he or she might react more to it because they might process the information differently. And so we want to test this. So we define this dummy for the information preference for the item that is ranked highest, and then we just interact this with the treatment effect. We control for a couple of things, and then here basically the coefficient psi-k measures the information preference effect, which is the treatment effect of an individual who prefers the information she receives, minus the treatment effect of an individual who does not prefer that information. And so here's what we find. So we do find information preference effects. So interestingly, people who prefer information about the price-earnings ratio respond to this information in a way that is more in line with rational expectations. So mainly, they revise their return expectation downwards much more, and by like 3 to 5%. So that's again quite meaningful numbers. And interestingly, so then in the second wave, we also asked them for the dividend growth expectation, and there we do not find significant effects. So that's very much in line with basically results from the return predictability literature, and suggests that there's a fraction of the people, so this were around like 20% of the sample, who actually do think that price-earnings ratio information is important. They are better informed about this, but not perfectly. And when they get more information, they actually update in the direction that you would expect, or maybe most economists would update. We found no information preference effect for return extrapolation, but we do find this for earnings growth, again, quite strongly. And here, so this basically saying that, so like people maybe who have in mind such a model in which, the fundamentals are basically really important for asset price, and they behave in line with such models in which agents are learning about fundamentals, like Border law, Schleifer et al. And so on. So basically, so overall, it suggests that people seem to have different mental models of the economy, and these affect both their information acquisition and their information processing. So, okay, finally, let's turn to portfolio choice. So here's first some just a correlation. So basically, when we plot the expected returns on the horizontal axis and the equity share that people choose on a vertical axis, we find that portfolio shares are positively correlated with expected returns. But it's, of course, just a correlation. And so here we basically follow the approach of Chilio et al. We want to test the Merton model, and therefore we estimate this equation where we basically regress the portfolio share on people's expected equity premium. But then different to Chilio et al., we address the challenge of endogeneity and also of measurement errors, which are quite important for survey data. We address this challenge in a specific way. And ultimately want to find out whether there's this causal link, right? Because, I mean, things can be correlated for many reasons, and there can be reverse causality and whatnot. But we really want to know whether there's really this causal link from the expectations to the portfolio shares. So yeah, so that's basically what this paper is about, right? So first we want to know the causal mechanism that is shaping people's expectations, and then we want to know the causal link between these expectations and basically their asset demand, and then basically we know what we need to know for our models. And the solution we do here is that, of course, we exploit the exogenous variation in the beliefs that our experiment generates. So these treatments are exogenous and randomly assigned. So basically, we can instrument people's expectations with them. And so here's the result. So basically, the first column shows the OLS regression of this first equation that I've shown you, and the second column shows you the IV estimate. And as you can see, this positive coefficient from the OLS equation, it does not go away. It could have been that it goes to 0 or something, but it actually becomes bigger, which has to do with measurement noise, and like this treatment variation can help us to mitigate this. The attenuation bias from measurement noise. And so we get these coefficients, and then like in the last row, we plot what the implied level of risk aversion would be from these estimates. And so basically the first point is that we say, okay, there is this causal link between beliefs and portfolios because we find this large positive coefficient. But then the second issue is like, okay, so people, the expectations matter, but like what is the coefficient of risk aversion that you would need in a standard model to rationalize their choices? And there the problem is typically that you need a very high coefficient of risk aversion. And as you can see here, basically using this IV estimate brings down this required level of risk aversion. So here's another angle of, like showing that people act fairly rationally conditional on their beliefs. So we looked at the heterogeneity of this implied risk aversion, which we backed out basically from the model and these previous estimates. So that's basically on the vertical axis. And then on the horizontal axis, there's the answer from a separate survey question in which we ask people directly, what is your willingness to take risk in financial matters, like on a scale from 1 to 10. And then few people answered a 9 or a 10, so we bunched them into the 8 category. But basically what you can see is that there's this, so basically, so 10 here is the most risk-loving. So basically this negative slope means that there's a positive correlation between the coefficient of relative risk aversion that is backed out from the model and these prior estimates with this separate measure elicited from the survey. And so this also suggests that this is kind of a model consistent. So let me wrap up. So we conclude that individuals do not understand the relationship in valuation and returns, at least not on average. Instead, we find causal evidence for extrapolation of returns and earnings growth. We find that there's heterogeneity also in the information acquisition, which points to the fact that people seem to have different mental models of the economy, consistent with the research of Andre et al. And then conditional on their beliefs, households invest rationally. And so since we're here at the central bank conference, so this could be interesting to think about whether, if people have this kind of distorted beliefs, so maybe there could be some kind of information intervention which might mitigate bubbles and redistribution. And that's it from my side. I'm happy to take more questions if we still have a couple of minutes. Why? Because the equity premium matters?
Because that should matter for their investment, right?
Yeah, okay, so I see. So, okay, so the question was whether we should give people information about the excess return as opposed to the average equity return. So, yeah, I mean, I totally see your point. We could have done that as well. I guess we didn't do it because it seemed too complicated for us, because like the equity premium is something that economists understand very well, but maybe for households, we are happy if they understand what a stock return is. So therefore we chose this, and we are kind of assuming that, and also we are in this, I mean, at that time, we were still at this extremely low interest rate environment where it was also not anticipated that the interest rates would suddenly go up. So basically, we are kind of assuming that people are correctly pricing in like a fairly low interest rate, but yeah.
Okay, another questions? Yes. So I'm just really quick about the second step of the information preference.
Yeah.
Can you just briefly explain that step to me again, because I just wasn't 100% clear. This isn't a critical question, this is just for my understanding.
So how this works with the information preference?
Just that step of the second value step. Can you just explain that really quickly again?
You mean this? Yeah, so basically we just elicit like which information do you prefer, or basically people rank these 5 information items, so we get this ranking, and then we look at what is their first preferred information, because we would assume that, if information was costless, you would choose your first.
And then in the next step, I think that really does potentially reveal some expertise on the people who run that.
Yeah.
I think that's actually really neat. So perfect.
Yeah, I agree with you. So it's probably related to their mental models and to their sophistication. And actually, I think that's actually quite interesting, because I mean, every one of you who is working with expectations, you know that expectations are notoriously hard to explain by socio-demographics, right? And that's also the case here. I mean, what is always significant is like gender, right? So female respondents tend to react more to treatments, for instance. That's also the case here, but apart from that, it's really hard to explain expectations or expectations or revisions. And it seems like this information preference is picking up a dimension that is really important, but which is orthogonal basically to social demographics. So we also look at whether we can just explain these information preferences by social demographics, but that's not the case. So that really seems to be an important dimension.
Okay, hello everybody. My name is Maritta Paloviita. I come from the Bank of Finland. I will shortly present our paper in which we analyze responsiveness of consumer expectations in the euro area. This study is based on the new ECB Consumer Expectations Survey. This is joint work with Ewa Stanislawska, who works at the Central Bank of Poland. The usual disclaimers applies. As we all know, inflation expectations are in the core of monetary policy making. Central banks are monitoring and analyzing very intensively inflation expectations of professional forecasters and financial market participants. But in recent years, they have paid increasing attention also to consumer inflation expectations in order to improve monetary policy effectiveness and in order to improve communication to ordinary people. The ECB President Christine Lagarde emphasized in 2020 for the actual process of setting wages and prices, it's the expectations of the public that matters most. After a long period of persistently low inflation rates, central banks are now facing the problem of rapidly accelerating inflation. This reflects pandemic-related imbalances in supply and demand, and also, of course, the Russia-Ukraine war has further restricted supply, especially for commodities. The future prospect of inflation largely depends on the way consumer inflation expectations adjust to elevated inflation. If consumers think that the current high inflation is only temporary, the impact of price and wage setting is likely to be quite limited. From the monetary policy point of view, it's very important for central banks to analyze how consumer inflation expectations adjust to these changing conditions. Central banks are carefully analyzing now possible risks of the anchored inflation expectations. In this paper, the focus is on medium-term inflation expectations of consumers in the euro area. We analyze how they respond to changes in inflation perceptions and short-term inflation expectations. We also analyze whether and how responsiveness of consumer inflation expectations is related to consumers' financial literacy and their trust in the central bank. The ECB conducted this survey online in the middle of the pandemic. Using this survey information, we are able to analyze how the pandemic affected consumer inflation expectations. In our empirical analysis, we compared two different sub-periods, low inflationary period and high inflationary period. Our study contributes to the existing literature in several ways. It's related to studies which analyze responsiveness of inflation expectations. Until now, most of these studies have focused on inflation expectations of professional forecasters and financial market participants. But here we provide new evidence on euro area consumer inflation expectations based on new ECB survey. It's worth noting that responsiveness is closely related to concept of anchoring. However, anchoring is a broader concept. It typically refers to longer-term forecast horizon, and anchoring captures more features than limited responsiveness to short-term developments. We also contribute to the literature which analyzes the impact of COVID on expectations. We also analyzed the link between financial literacy and consumer inflation expectations. Financial literacy refers to knowledge of economic and financial concepts. We also analyze how the trust in the ECB and consumer inflation expectations are related. The trust in the central banks refers to confidence that the institution will fulfill its mandate. The ECB launched the new survey in January 2020. It's a monthly survey which is conducted online. The microdata has panel structure, and it includes information from the 6 largest euro area countries. The data covers about 85% of the euro area in terms of HICP weights. The sample size is about 10,000 respondents every month. Here we analyze 21 survey waves from April 2020 to December 2021. All in all, our dataset includes over 200,000 questionnaires completed by more than 20,000 consumers. On average, a consumer who participated in this survey responded on average on 6 survey waves. This new survey provides very timely and useful information on euro area households and consumers for policymakers. The data across countries is fully comparable, and it covers several topics. For example, consumption, inflation, household income, financial conditions, labor markets, housing markets. We analyze both qualitative and quantitative inflation views of consumers. Inflation perceptions, inflation expectations 1 year ahead, and inflation expectations between 2 to 3 years ahead. Our dataset also includes information about consumers' COVID concerns, their financial literacy, and trust in the ECB. Here we can see how quantitative questions on inflation views are formulated in this survey. The questions are quite standard, and similar questions can be found in many other consumer surveys. I only want to point that here the questions are related to prices in general in a country a person currently lives in. The left figure here shows that the euro area inflation, HICP inflation rate, was very close to 0 in 2020, but during the year 2021, it accelerated quite rapidly to 5%. Inflation views of consumers were very stable and close to 2% until mid-2021. These are medians. After the summer 2021, the median inflation perceptions increased gradually to 4% here, and short-term inflation expectations increased gradually to 3%. At the same time, however, it's interesting to notice that medium-term inflation expectations did not change. In this survey, consumers are asked to declare how seriously they are concerned about the impact of the pandemic on their own country's economic situation. When responding to this survey, they used a scale from 0, not concerned at all, to 10, extremely concerned. As we can see here, euro area consumers were highly worried about the pandemic. Almost in our sample, almost 20% of consumers declared that they are extremely worried about the pandemic. In the survey, consumers also tell how much do they trust in the European Central Bank. Again, in this case, they use the scale from 0 to 10. The figure in the left shows that in general, trust in the ECB is generally on a high level because dominant values lie between 5 and 8. The table shows that consumers with high trust in the ECB have systematically lower inflation expectations both in the short term and medium term than consumers with low trust in the ECB. The financial literacy test score is based on several questions which are related to savings accounts, real interest rates, diversification and interest compounding for loans. The figure shows that about 60% of consumers have the test score 2 or 3, and only 5% of them gets the value 0. And the table reveals that consumers with high financial literacy test score have systematically lower inflation expectations than those consumers who have low financial literacy test score. Next, I will very briefly summarize our main regressions and main estimation results. The first equation here indicates how medium-term inflation expectations of consumers respond to changes in inflation perceptions. And the second equation reveals how medium-term inflation expectations respond to changes in short-term inflation expectations. For comparison, we also estimate the third equation, which shows how short-term inflation expectations respond to changes in inflation perceptions. All equations include the COVID dummy variable, which is equal to 1 if a consumer's COVID concerns are higher in the current month than in the previous month. In these regressions, we also have a set of control variables, which are demographic characters like age and gender, employment, income level, and so on, consumer sentiment, and individual uncertainty. We also use time dummies and country dummies in these equations.
Excuse me, what is individual uncertainty?
We measure individual uncertainty based on probabilistic questions on short-term inflation expectations. Yeah, it's based on probabilities. Yeah. It's worth pointing out that in the first equation, medium-term inflation expectations are explained by inflation perceptions, not actual inflation. This is reasonable since many recent papers indicate that ordinary people, consumers, pay more attention to prices they experience in everyday life than official inflation numbers. In the second equation, medium-term inflation expectations are explained by short-term inflation expectations. Here we assume that short-term inflation expectations filter many current and short-term factors and shocks which affect inflation expectations in the medium term. For example, shocks in food prices and energy prices. Then a quick summary of our main estimation results. Here, this simple table shows how inflation expectations respond to changes in inflation perceptions. In this table, we show estimations for the full sample and the two sub-periods. Non-inflationary period, which refers to the year 2020, and inflationary period, which refers to year 2021. The first row in this table shows that both short-term and medium-term inflation expectations respond significantly to changes in inflation perceptions. It's interesting to notice that the estimated parameters for the two sub-periods are practically the same, so no change in responsiveness. However, in both cases, in both sub-periods, medium-term inflation expectations are less responsive, less sensitive than short-term inflation expectations. The second row shows that increasing COVID concerns of consumers contributed to higher inflation expectations, but only in the first only in the first sub-period when euro area inflation was very close to zero. The next table shows is related to responsiveness to changes in short-term inflation expectations. As I already mentioned, short-term inflation expectations filter many short-term factors and shocks which affect to medium-term inflation expectations. Again, here we summarize estimation results for the full sample and two sub-periods. The first row shows that the estimated coefficients are about 0.3 in all cases. Perceived inflation is one of the main drivers for consumer inflation expectations. The second row indicates that medium-term inflation expectations adjust to changes in inflation expectations even after orthogonalizing with respect to perceived inflation. It's interesting to notice that in this case, increasing the estimated parameters for the increasing COVID concerns are not significant. This likely reflects the fact that COVID concerns are already included in short-term inflation expectations. Here we analyze how financial literacy and responsiveness are related. Financial literacy, as I already mentioned, refer to knowledge of economic and financial concepts. It's the ability to use knowledge and skills to manage financial resources effectively. In this table, we report coefficient estimates for two separate groups of consumers. Consumers with low financial literacy and consumers with high financial literacy. And the table shows that consumers with high financial literacy have less sensitive medium-term inflation expectations than consumers with low financial literacy. And finally, a table related to responsiveness and trust in the ECB. Again, we report here estimates for two separate groups of consumers. Those who have low trust in the ECB and those who declare high trust in the ECB. And our estimations indicate that consumers with high level of trust in the ECB have less responsive expectations than consumers with low level of trust. And it's worth noting that only those consumers who have low level of trust in the central bank expected in our sample that the pandemic has long-lasting effects on inflation. Then it's time to conclude. So in this paper we analyze responsiveness of consumer inflation expectations in the euro area. Our study is based on the new ECB Consumer Expectations Survey. We provide new evidence that consumers' medium-term inflation expectations respond to changes to their short-term inflation expectations and to a smaller extent to changes in inflation perceptions. We find that medium-term inflation expectations are less responsive than short-term inflation expectations. Comparison of two different sub-periods indicate that responsiveness to short-term inflation expectations increased slightly in 2021 compared to the previous year. On the other hand, we show that increasing COVID concerns contributed to increasing inflation expectations in 2020, but not in 2021. We also found systematic evidence that high trust in the ECB and high financial literacy are related to low responsiveness. This finding gives strong support for current education campaigns of many central banks for different consumer groups. In the end, I just want to mention that our current data set does not include the current year, 2022. But according to the latest CES information, medium-term inflation expectations of consumers in the euro area have increased quite rapidly in recent months. As Isabel Schnabel mentioned in Jackson Hole speech just a few days ago, the average medium-term inflation expectations of consumers are now almost 5%. So quite dramatic changes in the current year. According to the latest survey information, the right tail of the distribution has increased quite a lot. This was also mentioned by Philip Lane in yesterday's panel discussion. So what does this mean? It means that the central banks, the ECB and other central banks are currently analyzing and monitoring very closely whether and how responsiveness of consumer expectations change. Central banks are also following very closely how consumers with low financial literacy and high financial literacy revise their inflation expectations as a response to change in economic conditions.
So first, thanks a lot to the organizers for putting the paper on the program. We're very delighted to be part of this conference. A couple of comments on the intro slide. First, the usual disclaimer applies, although I forgot it. I'm from the Central Bank of Norway. Second one is not actually true, because it's still, the title of the paper is still 5 facts about the dynamics of stock market participation. We're still debating whether we should drop the 5 facts. You just call it the dynamics of stock market participation. But the facts are the same as in all papers, it's just matter of taste. Anyways, this is joint work with Akash Raja from LSE. So, sort of the most standard theory about stock market participation, going back to Merton and Samuelson's contribution in the 1960s, predict that all individuals, no matter how low their financial wealth is, should participate in the stock market. However, sort of a well-known and widespread fact is that actual participation rates are far below 100%. In the US, it's around 50%, and in many European countries, it's even lower than that. And there's a large literature that has tried to come up with explanations to understand this sort of under-participation puzzle, ranging from outright participation cost of participating in the stock market, which could sort of keep the poor individuals out of the stock market. Non-standard preferences, such as, for instance, people who just really dislike losing money, so loss aversion, or, for instance, that their labor income is correlated with the stock returns. It could also generate sort of non-participation, and other explanations. However, most of these explanations on stock market participation focus on trying to understand why there's, in any given point in time, is a large fraction of individuals outside of the stock market. But much less is known about sort of the dynamics of participation for individuals, how participation status changes over time. So, for instance, are the set of participants fixed? So there's one set of people participating, another set of people not participating, or if not, do people move just in and stay there, or do they move in and out, or how frequently do they sort of switch between being in the stock market or not? So in this paper, we're going to study these dynamics and trying to discuss what the findings may have to say about the existing theories of stock market participation. So the roadmap of the paper is like clearly two stages, two parts of the paper. So the first part is essentially documenting, which we think the first paper to do, sort of long run, individuals' participation status over a long time horizon. In the second part of the paper, we're going to confront the findings, these empirical facts, with the existing theories of stock market participation, and sort of in current version of the paper, it's more of like a discussion of whether existing theories may explain this. And then in the third part of the paper, we're going to propose a simple behavioral theory of stock market participation that can explain all these, all the facts that we find in the paper. Just to mention that we're still kind of in the current revision of the paper, we're going to embed sort of 2 and 3 into a more formal framework. So we're going to sort of confront existing life cycle models of stock market participation with our facts, and then embed our behavioral elements into a more standard life cycle participation model. But that's on the to-do list. So the main part of the paper is about these empirical, sort of documenting these empirical facts. So what do we find? Well, we find that short and multiple spells are quite common. With spells, I mean spells of participating in the stock market. So, with regard to the short, almost 1/4 of participation spells ends within 1 or 2 years. And these short spells are more common or more commonly associated with characteristics that are typically linked to low financial literacy. We also find evidence of a pure duration dependence in stock market participation, which means that the longer an individual has been in the stock market, the less likely is it that the individual is leaving. We also find evidence of, document also that there's quite a high frequency of multiple spells. So re-entry is quite common, and this is more common again for financially for individuals with high financial literacy, or characteristics associated with high financial literacy. If people re-enter, they actually re-enter quite quickly, often even as quickly as 1 year after they exited. And again, like for the duration dependence of exit, we find a similar sort of negative duration dependence of re-entry. So the longer you've been out of the market, the less likely is it that you will re-enter again. And in the sort of the model part of the paper, we're proposing a theory of participation where individuals have heterogeneous abilities and they're unsure about their own ability, but they learn about their ability using their own observed experienced returns. But then they suffer from somewhat imperfect memory so that they don't recall the past with perfect, they don't recall the past perfectly. So we'll show that this very simple behavioral model will be able to explain all these 5 facts. Okay, so what the data are we using in this paper? So the data source is the large Norwegian administrative tax records. So one thing to note about the Norwegian tax system is the presence of a wealth tax, which is quite uncommon. And the wealth tax means that we get information of individuals' asset holdings across relatively detailed asset classes. So for instance, so this is a yearly snapshot, the status as of December 31st. We know individuals' financial wealth positions in, for instance, deposits and cash, whether they hold anything in directly held listed stocks, unlisted stocks, whether they hold money in mutual bond or equity funds, money market funds, or whether they have financial wealth abroad. We also see other wealth categories, real wealth categories, such as housing. So one advantage of this data set is that it's likely to have very low measurement error, in contrast to potentially measurement errors in survey data. The reason is that it's, for the most part, third-party reported. So it's the sources here is not reported directly, or the data here is not reported directly by the individuals themselves, but from their, for instance, bank or brokerage firm. We have a very long time dimension. It starts in 1993 and ends in 2018, and we can link it to other administrative data, so we get information about the individuals' socio-demographic status and so forth. So with 26 years of data, we have a quite long time span for which we can study individuals, potentially study individuals' participation and behavior, and covers the whole Norwegian population, which means that there's, except for death and immigration, no random attrition in the data sets. One small drawback is that we don't have any detailed information about the individual's pension wealth, and so to the extent that pension wealth is exposed to the stock market risk, we may kind of report or under-observe participation. However, we're going to show you some robustness checks where we claim that this is likely not going to be any big concern. Finally, we define the individuals as a participant in the stock market if the individual holds a positive amount of wealth in either directly held listed stocks, so think about the stock exchange, if they hold money in stock mutual funds, or whether they hold financial wealth abroad. So this definition is in line with a recent paper by Fabra and co-authors studying the sort of heterogeneous returns in risky assets across households in Norway. All right. Okay, so fact 1, short spells are common. So what we plot here is the proportion of started participation spells that lasts for 1, 5, 10, and so forth years. And the right column here are participation spells that are right censored because they are still active in 2018 when the data set stops. But when we compute these proportions, we only include participation spells that started in 2015 or earlier. So if the participation spell lasted for only up to 3 years, we observe whether people exited or not before that. So what we see here, simply just counting participation spells, and that around 15% of spells ends already after just 1 year, and up to 23% end already after 2 years. So it seems that people are going into the market, the risky market, and then withdrawing again quite quickly, a large proportion of investors. Now, one concern you may have with this is that there are several potential measurement issues with the way we do it. So one is that we work with the individual level. So you might be concerned that we observe that an individual suddenly has reports 0 risky assets in the wealth on the tax report, because simply what has happened is that the wealth has been moved to the spouse's tax return for some tax reasons. We redo the analysis at the household level using household identifiers in that administrative data set, linking spouses together, and the pattern is the same, basically. Another concern you may have is that what we really see here are people not actively taking a decision about participation, but that is actually someone who's kind of involuntarily participating because they received, say, some risky asset as a gift or inheritance, and what we really see is that people just held on for that position for some time, but then really didn't want it and got rid of it. We redo the analysis where because in this tax data we can, people report whether they have received gifts or inheritance. We can exclude anyone who receives gifts or inheritance in the year they enter the stock market. And the pattern is the same. And also, since gifts aren't really taxable, it's just something that, so there's no reason, so there's no consequence of misreporting gifts, for instance. We also, or even inheritance in the recent years, we also, since there's no inheritance tax anymore, we also exclude people whose grandparents or parents died in their time around when they entered participation, and we still see the same pattern. A fourth robustness check is to remove individuals who own stocks in the company they work for, which is quite common. And that could mean that when they start a job, they will acquire this company stock, and when they quit, potentially after a few years, they sell the stock. We remove individuals who own stocks in their own company, in the company they work for, and we still find the same evidence. All right, so we think this is quite robust fact that a lot of participants seems to enter the risky asset market and then leave quickly thereafter. We study not whether we can say anything about what characteristic causally explains this, but kind of correlates with short spells behavior. So what we do is that we regress the probability of a spell ending within 2 years on a range of characteristics, including individual fixed effects and time fixed effects. And so here we report both with and without individual fixed effects. What we see here from this table is that at least having a college degree is negatively associated with having short spells. So it seems that people who have a college degree, when they enter, seems to be participating for a longer period compared to people without a college degree. We include fixed effects for income and wealth deciles, and we clearly see a negative relationship between the propensity of having a short spell and income. So the higher labor income you have, the fewer people have short spells. And the same for wealth. The higher wealth you have, the fewer people have short spells. How did I do this again? Okay, yeah. All right, so this is what we say when we link then this propensity to have short stock market spells with financial literacy. It essentially means that it correlates with income and wealth and education. Okay, so to the second fact, where we document that people have, the data exhibits a negative duration dependence. So the question we're asking here are simply whether investors are more likely to exit soon after entry or after staying in the market for a longer period of time. So what essentially at any given horizon, what's the likelihood of you exiting the market at that point? Conditional not having exited yet. This is typically known as a hazard function, where HD, where HD gives the probability of exiting D years after entry. Well, the standard challenge with estimating this hazard function is one of dynamic selection, which means simply that you could find that, for instance, that the likelihood of exiting at a given horizon D falls with D, simply because there's the group of still participating individuals are people who have a sort of a individual fixed propensity, low propensity to exit. So the ones you have individuals are grouped into sort of people grouped into people with high propensity to exit and low propensity to exit, and over time, as the high propensity to exit individuals leaves the market, it's only these people with low likelihood of exiting that remains. We utilize the fact that we have individuals with multiple spells in the data. And with multiple spells, you can think about then we having two observations for the same individual, and in some sense we can sort of take out an individual fixed propensity to exit using these multiple spells data. I'm using a GMM estimator of Alvarez. I'm not going to go into details on this, but essentially what we find is a highly downward sloping hazard function. So this is normalized to 1 after a spell of 1 year, and we see that even in the second year of participating, the likelihood of exiting at that point has dropped with 40% relative to the first year. So it seems to be quite high duration dependence in the data. Okay, so re-entry does occur in the data. In the right graph, we plot for the proportion of participation spells, proportion of individuals with the participation in the data who has either just 1 year of participation, one spell, or 2, 3, or 4 spells. So more than 30% of individuals who participate have multiple spells in the data. And we do the same kind of regression as we did with the likelihood of having a short spell. This is the likelihood of re-entering, and it correlates inversely with the same objects that we saw for the probability of having a short spell. So you're more likely to re-enter if you have high income and high wealth. This is plotting the proportion of re-entrants, how many years it has been since you exited for re-entrants. So we see that almost 45% of the re-entrants in our sample re-enter only 1 year after they exited. And as again, we do this, we utilize the fact that people have multiple spells and try to estimate a duration dependence of re-entry probabilities. And we also find a highly downward sloping duration dependence. So you're after around 10 years out of the market, you basically have 0 probability of going back into the stock market again. All right, so those are sort of the dynamic facts. To summarize, we observe in the data that people have short and multiple spells. So can sort of the standard theories of stock market participation potentially explain this? So without going into detail in all of these explanations, we argue that they are unlikely to do so. For instance, with preferences and risks faced by households, you need to require that some kind of preferences are changing abruptly just after you entered, and the same with this potential correlation between labor income and stock market returns. Participation cost could potentially explain why short spells occurs, because if there's a participation cost, you won't enter the market unless your wealth is above a certain threshold. If you enter the market when the wealth crosses its participation threshold, and then you receive a negative shock, you would exit if you receive a negative shock just thereafter. However, it's kind of unlikely that this could then explain why people quickly re-enter again. It would require a potentially very volatile process for the wealth. What we're in the process of doing now is to actually take the off-the-shelf dynamic life cycle model of participation and actually test whether this occurs at any given significance in these standard models that is out there. Okay, so basically we also check whether liquidity shocks could explain this, whether people who have short spells for some reason are more likely to have received an unemployment shock, divorced, or bought a house in the exit year. It doesn't seem to be any more likelihood that people with short spells are more likely to experience these liquidity shocks than people with long spells. I won't have time to go through the details of the model. Essentially, it's a model of stock market participation where people are either high or low ability. They enter the market without knowing their ability, but they infer about their ability from their realized returns. So high ability earn return above the risk-free rate in expectation. The low ability guys earn returns below the risk-free rate, and if they knew their type, they wouldn't enter. But when they enter, they don't really know their type. They learn about it through their performance. But then it's difficult to keep track of all your past returns, so we add some noise to your past recollection of your returns. So sometimes you forgot that you were a bad ability type. Sometimes you thought you were better than you really were. Essentially, this simple model can explain the distribution of spell lengths, the downward sloping hazard functions, and the multiple spells, and the downward sloping re-entry hazard function. So thanks a lot for your attention. I'll conclude with that.
So thanks very much for the invitation to present this work. This is joint work with Jamie Cohen and Emil Kashyap. And in this paper, we look at how consumers pick their mortgages and how lenders design the menu. And we can do this because we've got a unique data set where not only do we have the information that you see for the mortgage that the consumer picked out, but we're also able to match it to the menu of available options that they would have qualified for. So quick headline of the results. So most people face a daunting number of mortgages from which they qualify for. And on average, people don't really pick particularly well in an ordinal sense. But this doesn't really matter from a financial cost perspective. The implications are fairly small. There is, however, a small group of people that do end up making some very expensive choices. And as a result, end up leaving a lot of money on the table. And these guys are the highly leveraged consumers, which is strongly correlated with them being young first-time buyers. But also, importantly, they're people who are faced with bad menus. And when I talk about a bad menu, I'm talking about a menu with a huge amount of price dispersion. And as a result, they end up picking these very expensive choices. So in the paper, we go through a whole number of reasons or hypotheses on why this might be so. We kind of knock down these hypotheses, and we think it's a price discrimination story where banks are profiting from the poor decision-making of consumers or the lack of available options. So the literature is fairly broad. It kind of goes into 3 different streams. There's a whole number of papers on the UK mortgage market that have kind of recently come to the fore. They use the same data that we're using or similar vintages of the data that we're using. They find some kind of very interesting and similar results where, for example, consumers are kind of chasing low fees and as a result end up like paying a lot more for their mortgages. There's some papers looking like Claudia Robles-Garcia's paper or my paper with Mateusz, where we kind of find that you know, if you go to a broker, you're much more likely to make better choices. And then there's a whole range of other papers on kind of product choice and shopping, comparison shopping, and the kind of the general nexus of this is that you know, you should shop around, that if you're just going to kind of one mortgage lender or one you know, seller, you're probably going to lose out or potentially leave a lot of money. And then there's work on kind of price dispersion, and in particular the work by Menzies, the theoretical work by Menzies and Tractor, which we borrow from to try to help explain some of the narrative in what we observe. So we use 2 different types of data. The first data is the product sales database. This is the administrative data on the universe of mortgages in the UK. We restrict this analysis for the top 6 lenders in the UK where we have available information, and they constitute roughly about 75% of the mortgage market. And this information, this data has information on people's individual characteristics, such as their age, their income, and it obviously has all the information that you would have given to your lender at the time of mortgage takeout. So your interest, the interest rate that you're paying, the value on your property, how much you've borrowed. And we do this for 5 years, from 2009 to 2014. And then we match this with the whole universe of the mortgages that would have been on offer at the time that the individual would have taken out the loan. And this allows us to be able to compare the mortgage that people picked out versus what they would have been, what they could have qualified for. Go on. So the way the mortgage market is, so are you saying, like, you know, are some mortgages, some people qualify for some and not for others? Yeah, like that's, yeah. So mortgages are typically organized by loan to values and by loan size. So in some cases, so for instance, if you're a 95% LTV borrower, you can only borrow 95% LTV mortgages. If you're, say, an 80% LTV borrower, which means you put a 20% down payment, you qualify for the 80% LTVs, but you could also take out a 95% LTV. So there is the criteria. Okay, so the period that we use in particular is important because the stress testing criteria came into place basically towards the end of 2014, middle of 2014. So this would have been prior to any kind of particular stress testing criteria. Now, of course, income matters because, you know, your credit history matters. For these particular types of borrowers where, like, maybe they're, you know, they don't meet the threshold on incomes and so on, they usually go to specialist lenders. So generally speaking, the universe that you have here, these are people who typically have good credit history, would have qualified for the loan if they were able to put down the right down payment. And it would have been before the period of any kind of stress testing where they would have stress tested them for, say, like a period of 5 years of the loan and so on. So it should be okay. But it's a good question. Okay, so in the UK, for the mortgage market, it's typically a short period, initial period of about 2, 3, or 5 years. Most mortgages are fixed for that period. And then after that, it goes on to a long period of a floating rate mortgage for the remainder of your mortgage term of about 25 years. And people, of course, aren't just on this long floating rate for the remainder of the term. They typically refinance multiple times. There are 5 components to a mortgage. There is the initial period, the 2, 3, or 5 years. There's that initial interest rate that's associated with that period. Typically, you would, you know, if you did pay a fee, not everybody pays a fee, but if you did, it would be about £500 to £1,000. Then the mortgage resets to the standard variable rate or the floating rate. And then mortgage products are organized by the loan to value ratios, depending on the size of the down payment that you've put down. And the typical borrower we have in our sample takes out a loan of £160,000, puts a down payment of $40,000, so a house value of $200,000, and usually has take-home pay of about £3,500 a month. And customers face multiple product menus at multiple banks. And so when it comes to evaluating people's choices, what we want to do is try to compare from a cost perspective just what the price, how much they ended up paying on their mortgage, and ideally relative to some kind of benchmark or baseline mortgage. So we do a sift of all the mortgages that people would have qualified for the particular LTV that they would have taken out, for the given loan amount that they would have paid for, and for restricting it for the initial payment period that they would have taken out. And we do this sift both within the bank that they shopped at, but also across all the 6 banks. For the purposes of this presentation, I'm only going to focus on the across bank analysis. The within bank stuff, the results hold for that too, and in fact, I'm going to get that in the next slide. It's actually quite interesting because it does help us kind of tease out potentially some of the underlying mechanisms and knock down some of the alternative theories. We then compute the net present value payment for the first 7 years of the loan. We do an ordinal ranking of these NPVs, and then we need a baseline mortgage to calculate the cost difference. So we could choose the cheapest mortgage that's on offer. What we do is we take something a little bit more conservative and we say we're going to choose the 15th percentile of the choice set as a way to guarantee that, you know, whatever results we find is like one measure of robustness that we have. Okay, so what are the advantages of doing this kind of looking at the SIFT both within the bank that you shopped at versus doing a SIFT for across the banks that you shopped at? So we know that if we're comparing mortgage products within the bank that you shopped at, for sure, you would have seen those products because we know you went to that bank. So it definitely covers choices that would have been available, and that way it helps us reveal a little bit more about how that particular bank would have price discriminated. Now the con, of course, is that typically people don't just necessarily just shop at one bank, especially for such a large financial decision as taking out a mortgage. So that's a restriction. So that then says, okay, well, let's compare it to the universe of mortgages that we have. And so the pro in this is that, you know, these are big banks. They're scattered all over the region. Probably this is a much closer representation to the available options that people would have shopped at. But of course, the con is the reverse of the benefit of the other one. We don't know 100% whether they went to all 6 banks or actually they went to 4 out of the 6 banks. But I guess the thing to say is that the two of them together help kind of, you know, they're both like one extreme from either end. So if you look at the median borrower, what you find is that they're faced with about 70 choices across the 6 banks from which they choose. And there are some borrowers that are facing an upwards of 100 mortgage products that they're qualifying for across if they went to all 6 banks. And in terms of the ranking, the median borrower, in an ordinal sense, is picking the 47th percentile. So they're not exactly hitting the bullseye when it comes to picking really well. But what the CDF below shows is that this doesn't really matter so much in terms of how much money they're leaving on the table. So the x-axis on this chart shows the cost difference between the mortgage that they picked out and this baseline mortgage at the 15th percentile as a percentage of their take-home pay. And what you see is that most people don't really leave more than 1% of their net income on the table, and some people, the positive from the 0 are actually doing better than the 15th percentile. But there is a group of people that are leaving a lot of money on the table. This is sort of the tail. They're leaving 2-3% of their monthly take-home pay. So we define an expensive choice as something that costs at least 2.5% of your net monthly income. So let's think about how expensive choices are coming about. Well, they can come from one of 2 angles. The first is, do you know how to pick, right? You've been given a whole set. Are you able to actually extract well from the set that you've been given? And one very crude way we do this, but you know, we do a whole bunch of other things as well, is you can just look at the percentile ranking of the choice set that you have, and in particular of the set of choices that are available within the bank that you shopped at. But the second way that you might make an expensive choice is, were you faced with a bad menu? You know? And when I'm talking about a bad menu, I'm talking about this menu with a huge amount of price dispersion. And so we define a bad tail as our crude measure of price dispersion, where we look at the percentage of expensive choices that would have been on offer in your menu. And this is expensive relative to your baseline. So the baseline could be cheap or expensive. We're completely agnostic about how much the baseline costs. What we care about is, are there choices that cost at least 2.5% of your income relative to this baseline? So if you plot the probability of making an expensive choice in a particular month against the average size of the bad tail in that particular month, what you see is a strikingly positive relationship, which is essentially saying that as the percentage of bad tails increases, the probability of making an expensive choice goes up. But really what's striking about this chart is just how tight this relationship is. And the gray bands in this chart represent the 95% confidence interval. So what this is saying is that the menu quality is really the key driver in making these expensive choices. So who's getting the bad menu? Well, it's not surprising in a very kind of crude sense to say, well, maybe the people who are highly leveraged are the ones who are getting bad menus. But it is when you're thinking about it in the form of price dispersion, because we know that people who are highly leveraged are just, on average, are going to be faced with just much more expensive menus than people who are potentially low risk. But it's about this price dispersion difference, that even if you have your average mortgage is expensive, or your baseline mortgage is expensive, there's a whole proportion that's even much, much more expensive, and it's increasing. And it's increasing based on leverage. So the people who are very highly leveraged, the high LTV, the high LTI, these are the guys that are facing upwards of 15 to 20% of their menu option where there's a huge amount of price dispersion relative to people who are low LTVs and low LTIs. So the bank's offering bad menus to high LTV, high LTI customers. And, well, who are the high LTV, high LTI customers? Well, they're unsurprisingly they're the younger households, people who are younger than 30. They're your first-time borrowers. They're the ones, because of kind of where they are in the life cycle, are the ones who are going for these options. Okay, so can we disaggregate this thing about, do you know how to pick versus did you face a bad menu? So we do two things. We first look at the cost difference between the chosen mortgage, like the mortgage that you've chosen, versus the baseline in the bank that you've shopped at. This is a way to help us think about how well you've picked. And then we look at the average mortgage, the cost of the average mortgage in your chosen bank. So it's not necessarily the one you picked, just the average of that, versus the average mortgage in the cheapest bank that you could have shopped at, as a way to look to see just, is there also price dispersion across the different banks that you're shopping in. And these numbers are just how much more expensive these mortgages are. And what you see is that there aren't that many customers who end up losing a lot of money because of the choice that they've picked. Really, the cost, there's also a lot of cost dispersion across the different banks. So where you go, where you put your foot in the door basically can make a huge difference if you don't end up shopping around. So we do the same thing. We do it in a regression form. These are probit. Here we're looking at the probability of making an expensive choice. We have the two variables that I had in the previous table here, but we also control for the bad tail. This is that dispersion of the choice that you've picked. So we can see from the first two lines that there's definitely a role for, how well you've picked and where you shopped at. But really the big thing here is the bad tail, right? Like the big difference is actually just how much price dispersion that you faced And that's what's really leading to the driver of an expensive choice. So it's the menu quality that, that kind of really drives this you making an expensive choice. So who are the people that are choosing poorly? It's the first column tells you they're your usual suspects. So people who are younger than 30 are picking expensive choices. First-time buyers are much more likely to pick an expensive choice. And to a slightly lesser extent, poorer people, people in the lower third of the income distribution, are more likely to pick an expensive choice. That's not surprising. Then once you control for the bad tail, like we do in the second column, what you see is that this effect trumps everything else. So really, when you're saying young people don't know how to pick, or poor, first-time buyers really don't know how to pick, it's not necessarily that they don't know how to pick, it's actually they've just been given bad menus. And that's really the driver of all of that. So let's think about how the mechanism might work. So imagine that you have two different types of consumers. You've got sophisticated consumers. These guys are going to all the banks, and they are picking the cheapest product that's available. Then you've got these randomizers. These guys are randomly walking into a bank and picking a random option off the menu. So the bank wants to entice these sophisticated consumers, and they flood the market with cheap products in order to get most consumers who are sophisticated. And then they throw in a bunch of expensive options in there in order to profit from these randomizers. And importantly, price dispersion is increasing in the proportion of randomizers that you have in your grouping. This work is kind of slightly in the spirit of the Menzies-Tractor theoretical work, which looks at the relationship between price discrimination and price dispersion. So if you realize that young people and first-time buyers, they're the ones who are constrained, they're the high LTV, high LTI customers, they're the ones who can't necessarily afford a bigger mortgage, and they're potentially less likely, able to pick well. Like all the literature on financial literacy finds that. As a consequence, these are going to be the consumers who are much more likely to be picking out expensive mortgages. And remember, the banks are organizing their mortgage products, as was kind of asked earlier, by LTVs. So we know that the young consumers are the ones who are going to the high LTV products. So they're going to offer a menu that is increasing in price dispersion the higher the LTV, the higher the LTI. So in conclusion, people face a large number of choices. Most people don't pick particularly well, but the cost implications of this are fairly low. Competition is important. It's what disciplines the banks and protects the customers. And as a result, the banks end up offering very attractive menus to price consumers. And this is why most people, don't actually, it doesn't really cost them a lot of money. But there is a small group of people that do end up leaving a lot of money on the table. And we think it's because they face a menu with price dispersion. These are the young first-time buyers. And the theory that we have is we think this is consistent with banks using the menu to price discriminate. Thank you.